Hello everyone, my name is Gift Momaguju. I'm a financial analyst at FundMe Capital. So today let's look at Reliance Retail Limited financial standing. So Reliance Retail Limited is one of India's retail giants and is a subsidiary of Reliance Industries. So its areas of focus include groceries, apparel, electronics, etc. So the purpose of this tutorial is to walk you through how to compute ratios or how to perform financial analysis so that at the end of the day we gauge the financial standing of Reliance Retail. And I'll also show you how to come up with a common size income statement, a common size balance sheet, and I'm also going to show you how to calculate the free cash flow to the firm and the free cash flow to equity. So here's a completed version of it, a completed template for Reliance Retail that I did. So here you can see these are the ratios that I computed. Profitability ratios, liquidity ratios, efficiency ratios, and leverage ratios. And I also came up with the common size income statement and the common size balance sheet. And I also computed here the free cash flow to the firm using two methods, and the balance sheet method and also the other one where we actually use the formula as you know it, and the same with the free cash flow to equity. Right, so without wasting time, let's delve right into it. So here I've got 5 years of historical data, the income statement, the cash flow statement, and as well as the balance sheet here. So let's begin working on computing the financial ratios. So first of all, we just want to track revenue growth, right? So we'll start by computing the 5-year revenue compounded annual growth rate. So let's just do that here. So here I'm going to press the equal sign to initiate the formula, and I'm just going to go to the income statement here. So the income statement, I'm going to pick this revenue here, right? That's value of sales plus income from services, and then we have got revenue from operations. So this is the total that I'm going to pick here. So I'm going to pick revenue for 2024. I'll divide that by revenue for 2020, and then to the power 1/5, since it's for 5 years, then minus 1. Perfect. And here we get 14.6%. So what this essentially tells us that revenue for Reliance Retail has been growing by a CAGR of 14.6 each year, right? So here, in order for us to compute the 4-year average revenue growth rate, we first of all need to compute the year-on-year revenue growth rate. So I'm just going to initiate the formula here. So I'll go back to the income statement and I'll pick revenue for 2021. I'll divide it by revenue for 2020 minus 1, and then I'll copy that to the right. So as you can see here, this is in 2021 revenue grew by 2.18%. In 2022 it grew by 29.04%. 30.25% in 2023 and 15.11% in 2024. And the average here, so we just use the average formula, and then we take an average for the 4 years. So we get 19.14%. So for the past 4 years, the average revenue growth rate stood at 19.14%. Now we are done with tracking revenue growth. So now we want to calculate the profitability ratios. So here we will start by computing the gross profit margin. So gross profit, this is revenue minus the cost of goods sold. So that gross profit, we express it as a percentage of revenue, and that when we do that, we call it the gross profit margin. So let's just do that right now. So we are going to select the gross profit for the year 2020, and we divide it by the revenue from operations here, right? So let's just do that. So here we copy that to the right. So the gross profit margin tells us, in other words, it shows us how much revenue is left after we have subtracted or after we have removed the cost of goods sold. And sometimes it tells us more about the cost price relationship or the cost structure of the firm, right? In as much as the cost of goods sold is concerned. And here, after that, we will compute the EBIT margin. So EBIT stands for earnings before interest and tax. Some love to call it operating income or income from operations. That is, it shows us the portion of revenue left after accounting for business expenses or operating expenses. So to compute that, we have to pick the EBIT figure in the income statement and then divide it by revenue. So let's just do that. So here, this is EBIT, this is the EBIT figure, and then we divide it by the revenue from operations like this. And then we copy that to the right. And lastly, we have got the under these direct profitability ratios, we have got the net profit margin. So we take the residual income and then divide it by revenue. So this percentage or this ratio just shows us the percentage of revenue left after accounting for overheads or business expenses. So let's just do that. So we come here in the income statement, we pick the residual income, which is the net profit, and we divide it by revenue from operations, and then we copy that to the right. Now we move on to compute the return on equity. So this is a ratio that is very important to investors, because investors would like to see, like, how much the firm is generating per each dollar of equity in terms of income. So for example, so the formula is we divide the residual income or the net profit by the average total equity, or the average total shareholders equity. So let's just go here to the income statement and profit. We pick profit for 2021, we divide by the average, and then we pick the total shareholders equity in the balance sheet here. So we press enter, right? So we copy that to the right. So we are seeing that This is so if you are an investor, obviously any return on equity ratio that is above 20, I think that's acceptable, that's a good one, and that's lucrative, right? So now let's look at the return on assets. So the return on assets ratio, it shows us how much the company is generating in net income per dollar of asset, right? So here let's just compute that. So we divide net profit by average total assets. So here let's go back to the income statement. We pick here and then the average figure here, and then we come back and then we take the average of total assets, right? So we copy that to the right as well, right? So perfect. So here we are saying that at least in 2021 the company was at least generating about 10.7% per dollar of equity in income, right? But that has been declining going forward to 2024. Now let's look at the current asset ratio here. So the current asset ratio, this is a balance sheet ratio, right? So we compute the current asset ratio, the quick ratio, the cash ratio to gauge how to gauge if the firm is in a better position to meet its current liabilities, right? So here we go to the balance sheet. Under current assets, we take the total current asset figure, we divide it by the total current liabilities figure here. So here we copy that to the right. So current assets, these are assets that can quickly be turned into cash, and obviously basic current asset items include inventories and trade receivables, right? And current liabilities, these financial obligations that are expected to be settled within a year. So obviously under normal circumstances, a company's current assets must be able to settle the current liabilities, right? But it's not always the case. For example, in 2020, we are seeing that the company had about 93 cents to per each dollar of current liabilities. So you can actually say that the company had its current assets were not enough to cover current liabilities. But here we are seeing the company in 2021 had $1.15 in current assets to cover $1 of current liabilities, which is and I think the ratio deteriorated in 2022 but improved in 2023 up to 2024. Let's now look at the quick ratio or the acid test ratio. So what this ratio is all about is we will now remove inventory, since inventory is regarded as not highly liquid. So we are taking all the other assets that we think are highly liquid and compare them to our current liabilities to see if those high liquid assets can cover our current liabilities. So here we are just going to exclude the current the inventory, right, under the current assets. So here we just take a sum of all this here and then divide that by our current liabilities here, and then we copy that to the right. Perfect. So here we are seeing that the company doesn't have enough. In fact, the all highly liquid assets are not enough to cover current liabilities. So let's also look at only highly liquid current assets, such as here we look at cash, we look at investments in money market, and all other investments that can that the firm can quickly turn into cash. So let's go back to the balance sheet under current assets, and then we take cash, and we take investments, and we take other financial assets, and maybe other current liabilities, assuming that these are highly liquid, and then divide that by the total current liabilities figure. And obviously we are saying that our most highly liquid assets are not even enough to cover our current liabilities, right? So now we move on to computing efficiency ratios. So here we'll start by computing the inventory turnover ratio, the trade receivables turnover ratio, the trade payables turnover ratio. So the inventory turnover ratio, it shows us how many times the company replenishes its inventory, right? And the trade receivables turnover ratio shows us like how many times does the company collects money from its credit customers. And trade payables turnover ratio shows us how many times the company pays its creditors, right? So here let's do that. So to compute the inventory turnover ratio, we say cost of goods sold divided by average inventory. Okay, so here we'll initiate the formula in 2021, and then we go to the income statement, we pick the cost of goods sold here, and then we use the average formula. We go back to the balance sheet, and here we pick under current assets the average inventory, right, like this, and then we press enter, and then we copy that to the right. And here trade receivables, we divide sales by average trade receivables. So we pick the revenue, that's revenue from operations here for 2021, and we use the average formula here. So we come here and we take the average here for trade receivables, and then we copy that to the right, and we do the same here, cost of goods sold divided by trade payables. So here we come here, we take the cost of goods sold, we take the average, and we come back to the balance sheet under current liabilities, and then we take the average of trade payables, right? And once we have done this, once we are done computing this, we now want to see like how many days that does the company take to process inventory or to order inventory, right? So here we use 365 divided by the inventory turnover ratio. So yeah, we can see almost a month. And here we do the same, we divide that here, and then we copy that right through. Obviously the company now takes about like 7 days to collect money from its customers. 365 divided by year ish, right? So it takes now almost a month to pay its creditors, which is okay. And then we now want to calculate the asset turnover ratio. So we want to see like to find out if the company is utilizing its assets efficiently to generate revenue. So here we can do that. So we take revenue, here revenue from operations, we divide by average, right? Average total assets. So let's look for average total assets here. Perfect. So what we are saying here, obviously we measure the asset turnover ratio in times, right? But sometimes we might say the company generates about $3 in revenue per each dollar of assets. We have got a lot of degrees of freedom to explain whichever way we want this ratio, right? And we now move on to the leverage ratios. So here we compute the common leverage ratio, which is the total liabilities to total equity ratio. So here we utilize the balance sheet. So we take total liabilities, we divide by total equity, right? And then we copy that to the right. And here what this ratio is telling us in 2020 is that the company had 90 cents of debt per each dollar of equity. But now, as you are seeing, the company has been taking on more debt here, because you can see the ratio is increasing. Like in 2022, the company had $0.91 in debt per each dollar of equity, and in 2024 the company had $2.47 per each dollar of equity. So, and then we move on to compute the interest coverage ratio. So here we take EBIT, we divide it by the interest expense. So we use the balance, we use the income statement, we take EBIT, and then we divide by financial cost here, right? That's the interest expense. So here, perfect. So from 2023 to 2021, the company could cover its interest. The EBIT could cover the interest payments like 10 times, but that has been declining, and we are seeing that in 2024 the company's EBIT can only cover the interest expense like 4 times. All right. So so this is it for the Reliance Retail Limited on financial ratios, and now we can move to the common size income statement. So just before we move on to that section, if you've got any questions or suggestions on what we have just covered on these ratios, just feel free to let me know in the comment section, right? So if you have liked what we have covered so far, please just take a moment to subscribe and also like and share with your friends. Now let's move on to the common size income statement. So here, the common size income statement, here what we are essentially doing is we are expressing all income statement line items as a percentage of revenue, right? So here we are going to do something a bit different from what we have done previously. Like here, I'm just going to utilize this total revenue figure here as the top line, right? Is opposed to using revenue from operations. Why? Because this is revenue before we have removed like all these items. So we want to see like in what percentage, like the trends of each and every cost here. on the income statement. So to do that, we have to go back to the income statement here, and here we are going to pick this figure here for the value of sales, and then we divide that by the value of sales, which is revenue here. So here we come to this. So what we want to do, we want to use like relative referencing. So the way we want to do is we want to keep row 7 fixed, right? But we allow flexibility in column movements, right? So we use like F4 here. So if we press F4, you see we've anchored the column, we've anchored the row, but we don't want to anchor the column. We want to anchor only the row, right? So here we've anchored the row, which is row 7, F7, right? That's row 7. So we press like enter here, and then we copy that to the right, and we copy that down as well, like this. So we just want to bold totals only, right? So let's quickly bold totals only. So my Excel has been acting up here, so let's quickly do that. Let's bold here. Let's bold the gross profit. Let's also bold here, and let's also bold here. Perfect. So this is the common size income statement. So with this, you can quickly track like trends, like for the profit for the year. You can see that in 2020 the ratio was higher than what we are seeing like in 2024, and the profit has been like very volatile, because like in 2020 the ratio was like 3.78%. It deteriorated in 2021. It also declined in 2022. Slightly jumped a bit in 2023 to 2.8, and then also jumped to like 3.06. But you can see that was very volatile, and obviously we are also concerned with our EBIT. And it's been also the same with EBIT. You can see it's been volatile. But the good thing is it appears that now it's on an upward trend. And let's look at the gross profit. So we are seeing the gross profit has also been very much affected here. So this could be as a result of increasing like cost of goods sold, like you can actually tell here, because obviously if the gross profit ratio is declining, that means that cost of goods sold as well might be higher, and this trend confirms it. Like you can see it's been on an upward trend here, and obviously we can see revenue from operations that has been a bit volatile, but also increasing. So that was it. And here you can tell that value of sales, like revenue from selling products, contribute to the bulk of the firm's revenue, compared to revenue from providing services. So that was it for the common size income statement, and we can now proceed to common size balance sheet, right? So with common size balance sheet, we want to express all balance sheet line items as a percentage of total assets. So the reason is we want to track and identify trends, right, and patterns, from this data. And then here we take like the property, plant and equipment. We go back to the balance sheet, and here's the property, plant and equipment. So we want to keep row 25 fixed. So we do the same like what we did previously. So we just keep that fixed, and then we copy that to the right, and we copy that down as well, right? So here, perfect. So let's just remove all these empty spaces here, and let's also bold these totals. Here, let's remove these ones. Right, let's remove this, and let's remove this. Let's remove this and this as well. Perfect. So now we can easily identify trends, track even debt patterns, like here borrowings. Like in 2020 and 2021, the company didn't take any long-term debt. It took long-term debt from 2022 until 2024, and the debt has been it's been taking on more long-term debt. And borrowings, we can say the same here. It's also been volatile, but obviously it's been taking more of short-term borrowings as well. And even the total liabilities, you can actually see that they've been increasing, and mostly being driven by long-term debt here, and also borrowings and trade payables, right? In here you can see inventories have been on a decline, right? Have been declining here, you can see. And investments, trade receivables, they've been also declining, which is a good sign as well, because the company, like when we did trade receivables collection period, the company is now taking like 7 days to collect money from its credit customers. So it's actually a good thing as well. And the company is not keeping much inventory, which means they've got like faster selling products and all that, and a good inventory management system as well. So we are seeing quite a lot here. Property, plant and equipment makes up the bulk of the fixed assets, followed by the capital work in progress, and obviously intangible assets and other non-current assets here. So basically that was it on the common size balance sheet. So now we want to move on to computing the free cash flow to the firm. So so let's look at that. And here I've included like two methods. So the first one, we want to go with the flow of the financials, right? And the second method, we want to follow the formulas that right? So the free cash flow to the firm, this is cash flows. These are cash flows that are available to both equity and providers of capital, right? So and we use free cash flows to value the entire firm, all right, or to get the value of the entire firm. Free cash flow to the firm is also known as unlevered free cash flow, right? And the formula here is we start with EBIT, we act like we are paying taxes, depreciation and amortization expense, we add back, and changes in working capital, we subtract also the capex, right? So here I'm just going to link from the income statement the EBIT, right? So here we have got EBIT, so I'm just going to pick this figure here and copy that right through. And then we've got like the income, so we have to actually act like we are paying taxes on this. So the corporate tax is 25.17 here. So we multiply that by, so we go back here, we multiply that by here, perfect, and then we copy that right through. And then we link depreciation amortization from the cash flow statement, and we copy that right through. And changes in working capital, we just link from the cash flow statement, like here, total changes in working capital items, right? So we link that here. And then the capex, we also link from the cash flow statement. So here we have got this, so we just link that through here, perfect. And then we just sum up all these figures here, and then we copy that right through. Okay, so this is free cash flow to the firm, right? Yeah, so this is like a pre-debt cash flow. We haven't paid any debt, we haven't done anything, right? So here we want to do the same thing. So we sort of want to hard decode these figures here, like here, let's hard code these figures here, and let's just convert these the sign here. So we convert the sign, and in depreciation we just take it as is, right? So we do that. So we hard code that. And then changes in working capital, we reverse the signs. So if it is positive above, it is to be negative here. And the same we do for capital expenditure, right? Perfect. That's perfect, right? So here we are now applying the formula, right? Because like the formula says EBIT minus income tax plus depreciation minus changes in working capital minus capital expenditure. So here we subtract income tax, we add depreciation, we also subtract changes in working capital, we subtract capital expenditure. So we should get the same figures like like those ones here above here. So yeah, so here we applied the formula as it should be, and here we just computed our free cash flow to the firm going with the flow of the financial statements. And now we move on to compute the free cash flow to equity. So these are cash flows that are only attributed to equity holders, and we use free cash flows to equity to get the value of equity, right, in the firm. So here so the first one we're just going to go with the flow of the financial statements. So here we are going to link the net income here. This is the net income, and then we copy that right through. And depreciation, we also link that from the cash flow statement. So cash flow statement and changes in working capital. We also changes in working capital here. We link that as well. And capital expenditure. So capital expenditure, we have got purchase of property, plant, equipment, and other intangible assets, and proceeds from borrowings, non-current. So here, proceeds from borrowings, non-current. So let me find that proceeds from borrowings, non-current, right? Here, repayment of borrowings, non-current as well. So repayment of borrowings, non-current, right? And here we also link the movements in right. So here, perfect, like this. Great. So here that's fine. So here we just take the sum of all this and then right. So now we want to use our actual formula to see if we can get the same figures there, right? So depreciation, we take it as is. So depreciation we take as is. Changes in working capital. So changes in working capital, we have to flip the signs there. So let's flip the signs, right? The same with capital expenditure, we have to flip the these ones as well. Proceeds, right, proceeds, proceeds, I think here we can take as is as well. We can take as is, right? So okay, that's fine. Repayment of borrowings and all that. Okay, that's fine. So here let's flip the signs as well. Like proceeds, no, we cannot flip the signs. Let's just take as is, because that was cash inflow. So here let's take as is, right? So I think we can only flip the signs for this. So let's flip the signs there, right? And we can also flip the signs here, something like this. And then let's try to apply the formula here. So here, net income plus depreciation minus changes in working capital minus capex plus proceeds minus repayments, and then here we can work with a minus here. Perfect. And then we copy that right through. So this gives us the same figure here that we have here. So here, if you want to apply the actual formula, you have to really understand the flows and also be able to flip signs. Okay, so if you do that, you won't have any problems. So this is it, guys, and I hope you have enjoyed this tutorial. If you have got any questions, any suggestions, any comments, please let me know in the comment section below. And obviously don't forget to subscribe if you like my content, if you loved this tutorial, and also don't forget to share the tutorial with your friends, with your relatives, with your peers, and also with your workmates. Right. So if you've got any projects that you need help with, if you've got any projects that you need help with, like equity research, financial modeling, financial analysis, business valuation, I will be very glad to assist you. So get in touch with me, and I'll be able to assess. So have a lovely a weekend, and also have a lovely time with your friends, with your loved ones, and enjoy the holidays.